Hello and welcome to the Global View on this Thursday. Well, the US Federal Reserve has left rates on hold as expected, but the focus was on what comes next. Chairman Jerome Powell flagging that the Fed's monetary tightening policy is at an end and rates will be lower next year.
While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective.
17 of 19 Fed officials project that the policy rate will be lower by the end of 2024, with the median projection showing it falling 0.75 of a percentage point from the current 5.25% to 5.5% range. The Fed's policy statement said it would watch the economy to see if any additional rate hikes are needed. However, no officials see rates higher by the end of next year. Traders of futures contracts that track expectations of Fed policy raised the probability that the central bank would cut rates in March of next year by more than 60% following that decision and the release of the projections. US Treasury yields tumbled on that outlook, with the 10-year falling to its lowest level since August, down more than 14 basis points to 4.06%. The 2-year down to its lowest level since June, falling as much as 23 basis points to close at around 4.5%. And ahead of the Fed statement, US Treasury Secretary Janet Yellen said it would make sense for the central bank to consider lowering interest rates to keep the economy on an even keel, saying as inflation moves down, in a way, it's natural that interest rates come down somewhat because of real interest rates would otherwise increase, which would tend to tighten financial conditions. Meanwhile, the latest US data showed November producer prices were unchanged for the month, rising a less than forecast 0.9% on an annual basis. And the US dollar tumbled against most major currencies on the prospect of lower interest rates next year. The Aussie dollar trading at 66.6 US cents. All right, well, for some reaction to that Fed outlook and the market reaction too, John Blank joining us from Zacks Investment Research. John, very good to catch up with you. So, risk on in markets off the back of that outlook. What did you make of the statement from the Fed? Particularly the dot plots and the market reaction?
Andrew, I think the main thing to pick up here is the September projection had a 2.1% real GDP growth rate for 2023. That's now 2.6%. So a whole 0.5% from the Fed is a lot of move in 3 months. And that's actually 0.2% stronger than the London consensus that I track. So to even have the Fed outside the range of the London consensus right now is pretty amazing. But you also got to take that in mind with the core PCE went from 3.7 to 3.2. The broad PCE, which includes the fall in gas prices, which came down with the oil prices, is now 3.3 to 2.8. So you got 0.5% down on the core and broad PCE. You get a 2 handle on the broad, and you get 0.5 point of growth in 3 months' time. That is the real story here. It's just a total, it couldn't be, Goldilocks is underselling it. It couldn't have been a better, it was a best case scenario for the Fed. Let's put it that way.
Yeah, soft landing plus lower rates, obviously supportive for risk assets.
That's it. The whole focus right now is now they've got a 1.4% growth rate in 2024, and then they go back to the long-term trend at 1.8 and 1.9 and 25 and 6. So we're going to go from 2.6 to 1.4 here in 2024 from 2023. So that's a point, right? That's a 1.2% of lost growth. So the whole focus now is to make sure that's not any lower than 1.4 next year. So that's why they're cutting rates. That's why the pivot's on. That's why the market's actually cutting. You put a slide up beforehand about one chance for a 66%, 25 basis point cut in March without pointing out there's a 10% chance of a 50 basis point cut in March. So there you got it. It's just the range. There's only one person you can see who's actually calling at this point in time to just stay at the rates we're at for, in December. Everybody else is way down there. Typically, everybody looking for a 75 basis point cut from the Fed, but the market's in for a 25 basis point cut in March and then run one every basically every meeting the rest of the cycle. There'll be 7 meetings. So that's super aggressive. So basically everybody's calling the Fed's bluff. And the problem here is, does the Fed want this or not? That's the real issue here, because if they want, 75 basis points, then they think that's enough. But if the market goes ahead and throws in, like it did already get to 4% now, we can get 3.5% by the second half of the year, that might be too hot for the Fed. So it's going to be interesting here because the entire, way the market's thinking has changed dramatically in one meeting.
So, John, what, as an equity investor, what strategy should you be considering into 2024 then?
Well, you've got the Nasdaq at 42% year-to-date gains. You got the S&P 500 at 23% year-to-date gains. You got the Dow Jones at 12, and you've got the Russell at 10. So, at some point, Andrew, you got to play some valuations here and rotate into the stuff that's not moved as much as the tech stocks. I don't think you want to get over carried away with that, but after a 44% move or 42% move or whatever you want to call it, you gotta put some small caps or mid caps in your portfolio. You've got to start to rotate into industrial names in the Dow, stuff like that. You may not want to go in there whole hog, but you don't want to be caught, waiting around for the style rotation when these big hedge funds move out of these names in the Nasdaq. So that's the thing here. I would be looking for a broader participation in a market like this. When you've got a broad move that's coming from interest rates, you've got to believe there's more risk on and more rotation into other stuff, other beaten up stuff.
So of note, I see that Zacks there, you've got to focus on insurance stocks. Why is that? Yeah,
Andrew, this is what I talk about in terms of broadening out. Whoever would talk about insurance stocks as number one ranked stocks, we've never done a show like this. So you ask what happened. Well, it's all been in the last 30 days, right? Because when you get, 100 basis point down move in rates, all those bond prices go up that these insurance companies own. So every estimate revision has gone up 10% across the board in most every insurance company name. So here you've got an example where, you got P&C insurers, life insurers, you got these insurers of home and auto, stuff, or your computer and stuff like that are actually going to turn out to be good, strong plays. And even one of the names I looked into today, Assurant, is a growth name. So this is what's interesting. This is what happens in markets like this, where you're going to get this rotation out of anything but energy, basically.
All right, there's Assurant on the screen there. So that's one you're clearly interested in what provider of solutions in housing and lifestyle, yes?
Yeah, this is a fascinating one, Andrew. We got a number one rank on this stock, of A for value, a B for growth, a B for momentum. So just, classic, clean play. So you ask yourself, what is going on here? Why do I want to buy an insurance stock? Well, what they're in is in housing, autos, and then they're in this lifestyle market, which is all your global lifestyle, your computers, connected living, they call it. So they're basically giving you insurance contracts on all your equipment and stuff. All of which, by the way, if those names grow, because you get a growth out of auto because the rates fall, you get a growth out of housing because the rates fall, you get a growth out of all this connected living because if consumers strong, then their policies sell too. So there's actually a growth name here in the stock. After the latest revisions, $15 a share. You can pick it up for an 11.7 price earnings ratio, Andrew. With the S&P is like an 18 PE ratio. You can get in at 12. So this is what's interesting here. You can get a name like this that's already been at 190, buy it in the 170s, and you might even get in the 200s on a name like this in a market like this. So this is what happens here. People start to look into stuff like this, things that nobody thinks about, but are priced correctly, that have momentum on their side. And actually now with these rate structures, got their bond rate returns up and all their core markets are going to be cheaper. Very hard not to like a company like this.
All right, John, running short of time, let's just run through another couple of insurance stocks you're looking at here. Erie Indemnity.
Erie Indemnity, this is amazing. This stock is a target price of $376. $322 now. Just for example, if you bought this in the COVID pandemic, is at $150. So you double your money in this stock. So what's happened here? This stock is, again, like I talked to, this is 12% upgrade in revisions for 2024, 11% in 2025. This is true bond rate stuff. It all happened in the last month. So the question here is, they obviously have a lot more returns they're sitting on in their portfolios that they can handle in many different ways. That drives their earnings up. So does the market have this priced correctly or not? And this gets back to the early part of the show where people, you got to kind of, there is a bear case here that the market got ahead of itself.
Yep.
And stocks like this, will kind of tumble at the back end when people realize that. But, at the end of the day, you got to believe these consulting firms and these bond markets are probably calling the Fed out on this thing. And a place like Erie Indemnity is pretty attractive.
All right. And a quick look at CNA Financial, in the property and casualty.
Yeah, CNA Financial is the least attractive of these names, still range trading. But again, you've got to move off the lows for the earnings, last 30 days. This one actually pays a 4% dividend. So if you're looking for a dividend stock that's nice and stable, this is a great name. But this is a classic name. You can look at this chart, and all you see last 30 days is a big move up in their S provision. So why is that? It's not because their P&C business or life business is doing all that great. It's because the bond portfolios they rest all those insurance premiums on is doing great. So this is a classic thing. We know the stock market's up big. We know the growth names are up big, but also all the bond groups that are in the insurance business are up big too. So this is the story that, we haven't seen this in a long time, and there have been no reason to talk about insurance companies until basically November.
John, terrific to get your view, particularly that market reaction to the Fed, but also a couple of picks there. Thanks for joining us from Zacks Investment Research.
You bet, Andrew.
All right, that is the global view. Just a quick check. We are expecting a significantly higher up in there off the back of what we heard from the Fed. SPY futures up 1 1/10%. And the open is just around the corner. Stay with us.